Let's just be honest. If you're holding Constellation Software right now, your portfolio is bleeding.
Oh, it's ugly, really ugly.
I'm looking at a chart that's, frankly, horrific. It's down nearly 30% from the 2025 highs, scraping 52-week lows. And the narrative seems pretty simple, right?
Yeah, the story on the street is Mark Leonard resigned as president back in September, and poof, the magic's gone.
Exactly. The magic left the building with him. But, we've spent the last week just tearing apart the financials for our report, and I have to ask, is the market seeing something we're not? This feels like, well, like panic.
It is panic. Our research suggests it's completely wrong. We're issuing a strong buy on this. The market is pricing this like the machine is broken just because the original architects stepped back. But when we looked under the hood, I mean, the machine is running more efficiently than ever.
Yeah, but let's play devil's advocate for a second. The stock price collapsed. The market usually sniffs out rot before it hits the headlines. You're saying there's no operational rot.
None that we could find. The drop was purely a valuation reset. It was a Keyman premium. It evaporated.
Right, so investors were paying extra just for Leonard.
They were, but look at the operational reality we uncovered. While the share price tanked, free cash flow available to shareholders, it didn't just hold steady. It surged.
Surged by how much?
We're looking at a 46% year-over-year increase in Q3 2025. 46%.
Wow. Okay, so price is down 30%, but cash generation is up 46%.
Exactly. And that creates this just a violent disconnect in valuation. Right now, CSU is trading at roughly 17 times free cash flow.
Which for a compounder like this is, that's basement level pricing.
Its historical average is around 29 times. You are essentially getting the opportunity to buy a high-growth software compounder at a valuation usually reserved for, like, a boring, low-growth industrial firm.
But 17x is cheap for a reason. The market hates uncertainty. Mark Miller takes over, and the street acts like he's just some substitute teacher.
And that misconception is probably the biggest piece of alpha in our report. Mark Miller isn't a substitute. He's a 30-year veteran. He co-founded Trapeze Group.
Trapeze. That was Constellation's very first acquisition, wasn't it? Back in '95.
The very first one. So he's been there since literally day one.
Mm-hmm.
And he didn't just survive there. He helped build the operating system. You know how we always talk about their decentralized culture?
Mm-hmm.
Miller pioneered the peer networks at Valuation Group. He basically created a process that allows hundreds of these business units to benchmark against each other, without needing some charismatic leader holding their hand.
Because he replaced the person with a process.
That's the key insight. The culture is institutional now. Plus, he put his money where his mouth is. We saw the filings. He was buying shares on the open market during this crash.
Significant buys, too. Okay, so leadership seems stable. But what about the external threats? The other big fear is AI.
Right, the generative AI argument.
Yeah.
That it's going to obliterate the moats of all these little niche software companies.
Yeah, why own a vertical market software business if an LLM can just code a replacement in 10 seconds?
It's the #1 bear case. But our research suggests Constellation is actually positioned as the ultimate fast follower.
Meaning they don't have to invent the AI, they just have to apply it.
Think about it. They own over 800 business units. We view those as 800 separate laboratories. They don't have to take the big R&D risk. If one unit figures out how to use AI to cut support costs by 40%, they just
copy-paste it across the whole portfolio.
You got it. So it actually lowers the risk of adoption. And with private equity driving up prices, Constellation still wins on that permanent home promise. Founders sell to them because they know Miller won't just gut the business and flip it in 3 years.
So let's boil it all down. We have a panic-driven sell-off, a misunderstood CEO who actually built the company's operating system, and a valuation that just doesn't make any sense.
That's pretty much it. You're paying 17 times cash flow for a business that's growing that cash flow at 46%. That is a massive margin of safety.
It really makes you wonder, if a system is truly robust, shouldn't it function even better without the founder's day-to-day oversight?
I mean, isn't that the ultimate test? Whether the culture can truly outlive its creator? We're about to find out.